Good evening. Due to our live feed, we're going to be starting promptly in about 2 to 3 minutes. If you want to get a drink or snacks or anything like that. Thank you.
Okay, if I can just first of all welcome everyone here this evening and to those on the live streaming. I must say it's quite a unique thing for me to be talking to people who are not present, so welcome to all of you for the first time MICROmega have done this on a live streaming basis. I thought it might be useful at the beginning of the presentation to give background to probably most of you who don't know where the name MICROmega comes from. And the reason I think that is useful is a lot of what I'm going to talk about today really is about the philosophy and the ethos and what we're trying to achieve, and quite frankly why I think we can achieve it, because clearly the main purpose is to convince you all to buy the share. So I'm going to do my very, very best to do that. And it is quite an interesting story, the name MICROmega. I first came across, or not the name MICROmega itself, but there's a very famous French philosopher and satirist called Voltaire. And I was reading his collected works about 20 years ago. And Voltaire is better known for a satirical work called Candida, which he wrote after the famous Lisbon earthquake in 1750. And I read this very, very short story called Micromegas. And the story itself is not really important because it's almost a kind of sci-fi, kind of prior to the H.G. Wells days, probably the original sci-fi story. But I really was intrigued by the name MICROmegas, which was the main character. And I like the idea of the combination of the micro and the mega. And it struck me that from a business perspective, philosophically, it went in accordance with some of the things that I believe are important in running a business. So I rushed off and I registered the name MICROmega in the hope that one day I might use it in a company. And I think about 5 or 6 years later, when we started the MICROmega group, we called it MICROmega. And the reason for the name MICROmega in the combination, in fact, also very importantly, why the micro is large and the mega is small, is because there is a very, very strong belief throughout the group that the detail is what makes the bigger picture right. And one of the philosophies we have, and I think anyone that's worked for the group for a period of time will vouch for this, that we are very, very strong in making sure that the bigger picture is managed through the detail. I think there are many, many companies that have been successful and have grown quite quickly, but through lack of attention to detail, in fact, they fail. So we continually stress we are MICROmega. The name is there for a reason, and the reason the micro is large and not small is we're saying if you get the detail right, that helps in growing the bigger picture. So that, just interestingly, is why the company is called MICROmega. Slogan in itself, I think that we believe within the organization the differences in the detail, in fact, it's an attitude and it's a statement of intent. You know, it's one of the most important things that we believe in. In fact, I'll go as far as saying it's very, very difficult to grow a business at the rates that we have been growing the business at and at the rates we intend to keep on growing the business with, if in fact you don't get the detail right. And the detail is about attention to contracts, and detail is about getting proper accounts in place, management accounts, management reporting, and just never ever taking for granted that the growth in the market is there. And as you're growing, continue to understand that your focus on the detail is very, very critical if you're going to grow successfully. As I said earlier, there's many companies have grown, and in fact that growth has worked against them and they've ultimately collapsed. And it's one of the things that we're alert to, we're aware of, we continually drive through the organization that the detail is absolutely critical and never lose sight of the detail. If you look at the business, there are three key investment drivers that we apply in trying to grow the business. Some of them are fairly obvious, they're around profit, but it's not the obvious ones, it's really the combination of what we think we are trying to achieve. And the first one, so I've hit two there, the first one is headline earnings per share. We are very, very focused on driving our headline earnings per share. There are other earnings measures, there's attributable earnings, which are probably more affected by accounting standards, but as far as we are concerned, and in communicating with investors, we hope to be judged on our ability to continue to grow the headline earnings per share. Tied up to the headline earnings per share is cash. Now, it's obviously a very, very challenging exercise for any business to grow at the rates that we are growing at and also generate cash, because it just makes common sense if you're growing a business at a very, very high rate that a lot of the cash you're generating goes back into funding the business, to funding the growth and funding the working capital. And what we're trying to do is trying to be smart enough that we can grow the business, grow our HEPS at levels which will continue, we expect, to be way above the average that the market would be expecting from listed companies over the next couple of years. And simultaneously, we're hoping to do that with this very high relation with cash to earnings as we possibly can. It's a question that was posed to me last year, I think by one of the investors that Saxo brought there, who kind of queried whether we could grow at the rates that I was suggesting last year. I was hoping we might grow at and still generate cash. I said I thought we could do so, but it obviously is very, very challenging to do so. But it is very, very important, and our focus is on HEPS, but also making sure there's a very high correlation between earnings and cash generated. And the final one is dividends. In fact, if you take growth in headline earnings and simultaneously growth in cash and paying out dividends, I would suggest there are very, very few companies available in the world, in fact, who are able to do all three. It's what I refer to as being the holy grail when we published our results. And it's clearly a very, very challenging thing to do, but it is what we're trying to do, and trying to make sure we get the right combination of all three. And we think if we can get that right and continue to get it right, not get it right once off, it's something we've got to do repeatedly. It's a huge challenge, and we'll come later on in the presentation as to how we have been achieving that and why I believe that we can continue to do so. If you look at the performance in 2015 against the three measures that I've just highlighted as being the ones that we value the most, the headline earnings per share was up by 106%. And just to give you a sense, that was on the back of being up more than 100% for the previous period as well. So we've now got 2 periods in a row where we've grown at over 100%. And again, when I was standing here last year, I was asked the question, 100% is maybe fine once, but do you think you can do it again? And I think, my view was, yes, I do think we can do it again. There's no guarantee we can do it again. But if we stick to the same principles and we stick to what we've been doing, I do think we can, and we have done. So that was a phenomenal performance to everyone throughout the group. If you then look at the cash correlation, having indicated it's very tough to grow at these rates and generate cash, we in fact generated operating cash at above the level of growth. That can only be done, quite obviously it can only be done, if one has very, very strong working capital management. And I think it is an area the last year where the finance department has really come into its own, and there was a huge contribution from them in terms of working capital management. And there was a huge contribution from the businesses themselves in making sure that the commercial contracts that we're entering into are closely aligned with cash generative capabilities. So in many cases where we were funding debtors books, we've now got that down to 7 days. In many instances with our software contracts, we're now getting payment at the beginning of the month. So we've been very, very aggressive to try and make sure we run the business in a model that allows us to have that very high cash generative capability to support the growth in earnings. And then finally, we were able this year to increase the dividend by 75%, which is an indication, I think, of our confidence that we believe, certainly as we're standing here today, looking into the new financial year, that we think we will be able to continue to distribute an increase in earnings back to shareholders by way of dividend at a rate of about 75% of our earnings. Clearly we will keep some of the cash for the growth of the business, but we remain confident as we stand here today that we'll be able to continue to give 75% growth in dividends. And I repeat, that is very, very challenging to grow earnings and grow cash and distribute dividends with the rates of growth that we've got. I think it's very, very demanding, but I think it's something that we've done very, very well. And I think from looking at the structures, looking at everything we've got going through the group in terms of the attitude, as I stand here today, I'm confident that we'll be able to continue to grow the earnings and give higher cash dividends back to our shareholders. If we then look at the growth drivers, it's one thing for me to stand up here and say, like, trust us, we're growing well, we've had a couple of really good years, we think we understand something about growth and we think we can make it work. But let me also take you through why I think that we can make it work and what's important to us in looking at the growth drivers. Firstly, and very, very importantly, is the product and the services that we provide. We will not go into any business just based on the fact that we think we can get growth if we don't believe that the product and the service is one where not only can we grow, but we're looking for situations where that product and that service can give us an opportunity to gain a share in an existing market, but we're also looking at situations where we believe that market itself will give us growth. We're not looking for situations where we can acquire a market share and go from 0 to 10, but then we find out we're in an X growth market, and once we get to 10, we get stuck at 10. So everything we're looking at, all the products we're looking at, the services we're providing, we're looking for industries that are growing in themselves and opportunities for us to take market share out of that industry. And we'll test a little bit later whether our products and services qualify with the criteria that I'm setting out here. The second one is positioning. If one looks at a market and growing a market, and the simplest way I can state it is what we do not want to be in any of the markets that we operate in is a price taker. So by way of example, if you have a 10% market share, by definition you're a price taker. You can't make a price by owning 10% of a market. So what we're always looking to do is either find a market or find a segment within a market that we think we can own. So we would rather own 100% of 5% of a market than 10% of a market. Because if we own 100% of a smaller share of that market, we become a price maker, not a price taker. And if you're a price taker, your margins become subject to other people's demands, to other people's business needs, in fact, to other people's efficiencies. You might be running a better business than the competitor, but the inefficient business translates to inferior pricing, and that gets passed back to you if you're a price taker. So we're absolutely determined when we look at all of our businesses, we'll look at the organic growth opportunities, we'll look at the acquisition opportunities. Unless we feel we can go and dominate either a market or part of a market, then we'll stay away from that business. Infrastructure and resources. That is absolutely critical. We've grown at very, very high rates the last couple of years. During the course of this evening, I'm going to tell you repeatedly, we're going to continue to do that. And you cannot do that without the right infrastructure and resources. There are just so many companies out there that grow very, very quickly and find out that the growth in the business falls over because they haven't got the right infrastructure and resources. So we're very careful in how we grow the business. We're growing very aggressively. The numbers are very, very impressive, but what we're not going to do is grow at rates that are faster than we can manage. So by way of example, if we were fortunate enough, and I'll talk a little bit later about our local authority business, if Cape Town come along and said, we'll give you a contract for R1 billion, we wouldn't take it. It'd be enticing to take it, but we know we don't have the resources and the infrastructure to manage a leap change like that. So everything that we are doing, as much as we're growing, it's a managed, controlled growth, and it's all well within the infrastructure and resources and the management skills that we've got to grow the business. So it is very measured, it's very, very calculated, and we don't take pride in growth itself. It has to be a level of growth that we believe we can build on for the following year. And then management. Again, very, very key, and it goes hand in hand with the resources issue. If we don't have the right people in place, then again, it's going to affect our growth ability. So one of the things we continue looking at is the ability of the existing management team to grow. We're growing very fast organically. We're growing very, very, very fast by acquisitions, and it is quite stressful for the management team to try and manage that growth and take it on board themselves. So it's something that we're very alert to continue to support the management team in meeting the high growth levels, but also looking for opportunities to bring other people into the group as well to try and support the management team so that we have got people in place as we continue to grow the business. And then finally, deal makers. I think we do have that in abundance. Part of our strategy is to grow by acquisition. If you are going to grow by acquisition, it's very, very important to get the right deal. If you buy a company for the wrong price, you could run the company better than anyone else in the world and still not give a return to your shareholders. Whereas if you get the company for the right price, you could probably run it quite averagely and still make good money. And we are absolutely determined that we'll buy the right businesses at the right price. We won't overpay. I repeat that we're not in growth for the sake of growth. It's managed growth, and we'll only get involved in businesses that add value. So we're looking at having good deal-making skills at the corporate finance level, and I think we have that, and I think we have demonstrated an ability to properly identify transactions, an ability to properly price transactions, and an ability to properly integrate all acquisitions within the group once we've taken them over. And I think our success rate to date has been very, very good in acquiring businesses and bringing them into the group. We use the term, which I think is now quite in vogue, about plug and play. When we do look at acquisitions, we try and bring acquisitions that will immediately contribute to profit, but also, very, very importantly, they will continue to grow themselves at the rates that we want for the group as a whole. So what we're not looking to do is to acquire a business that gives an immediate boost just because we've good deal-making skills, but then find out that business is X growth in year 2, 3, 4, and 5. We'd rather walk away from a deal like that. So we're looking to do good deals, get the right deal for our shareholders, but then make sure that the businesses we acquire quickly adopt the, if I can call it, the MICROmega culture, and they themselves begin to contribute meaningfully to the growth going forward. If we look at the market sectors that we're involved in, and the first one is financial services, and I'll talk a little bit more about what we're doing there and what the future is for the financial services businesses. The second one is labour supply, and likewise I'll deal with that. Third one is information technology, and then finally the occupational health and safety businesses. That's the businesses we are in at the moment from a broad-based perspective, and as things stand at the moment, I don't see us departing too much from that. If I now look at the revenue for 2015, the year we've just completed, looking at these sectors, you'll see the financial services, which I bring up first, was relatively small. At the moment, it's only 4% of the total revenue. The labour supply business is 264 million rand of the revenue, so that's very substantial at 25%, and I'll talk more about that shortly. The IT businesses had a phenomenal year, both at the revenue level and at the profitability level, generated a turnover of 400 million, which is 39% of the total. And then finally, the kind of stalwart of MICROmega over all the years has been the NOSA, the health and safety business. Again, a phenomenal performance last year, 333 million turnover, and for the first time in the group's history, we managed to achieve a 1 billion rand turnover last year. So again, that was great credit to the whole management team. If I now look at where the earnings came from, financial services, again, 6 million rand, which was 5% of the total headline earnings. The labour supply business, and I will deal with it because it must be obvious to anyone looking at the figure, they did 250 million turnover and generated 2 million profit. I'll talk a little bit about why that is the case and how it kind of fits in with the previous discussions I was giving you. The IT businesses, 59 million. So a phenomenal performance from IT for the year, which looks like continuing into the current year. And then the occupational health and safety, again, record profits at 66 million. So still kind of hanging in there is the stalwart of the group, but under serious threat from the IT businesses. And then the one that comes up next is the one that always bothers me when I have to show it. Maybe that's why it's not coming up. Head office, minus 22 million rand. So every time I look at that one, it still gives me a bit of a fright as to how we can be taking 20% of our profits and spending it on head office. So what I thought it might be useful before everyone decides to leave early is explain that we're not quite as profligate as it might appear to be. So I'll just take you through some of what's in the head office costs. It also doesn't want to come up. Okay, compensation of, and these are after tax figures, so that's the headline earnings level. So of the head office cost, 9 million rand goes into compensation. So that's for paying for people like myself and Greg Morris and Russell Dick. It includes all of the head office accounting staff. It includes the travel department. It includes the facilities management. So it's quite a lot of money. What is nice about the compensation, I think, is that Greg, Russell, myself, and the accounting staff still have a lot of capacity. So if the group continues to grow at the rates we've been growing at, we're not going to double our salaries. So hopefully that becomes a relatively fixed cost in terms of the bigger picture. Rent cost is 3 million a year. Share options. Now the share options is a non-cash item, but it does come into the head office costs. And what happens there is in terms of the accounting standard, if you issue share options to staff, there's a Black-Scholes option model price calculation that the auditors put together, and they work out the economic cost, I'll call it, of issuing these share options, and then you have to take a charge against your P&L for the share options. So we're taking a 3 million charge for the share options that we award to all the staff. And then the sponsorship of 3 million for the year, which is the head office cost. That is mainly the what we call the MICROmega sharks. If they lose, we call them the LC sharks. When they win, we call them the MICROmega sharks, and that's by far the highest level of the sponsorship amount. And we're in there for one more year, so that figure will appear again this year and next year. Utilities, so it's your normal utilities you'd expect from any organization. And then the travel costs, which would be all the executive travel. And then the statutory costs are essentially the costs of, they're largely the costs of maintaining a JSE listing. It's all the costs of being a public company that you have to comply with. So that makes up the 22 million. So it's still a big number. It's a number that I think bothers us every time we see it, but I do think ultimately head office does pay for itself. And I repeat, the nice thing about that is I think we do have a level of infrastructure, we've got a level of accounting support and staff where I think that we can take on a lot of additional business and grow the business substantially without that increasing proportionately. So I think it is a cost that we've got under control, and it is something I think that is very, very important in supporting the growth in the business going forward. But it still does bother me every time I see the report, because it's the only one that's got brackets in it. This is, then the next two slides are really more interesting to me, and they're little fun slides in a sense that it's something I kind of look at, but I'm not suggesting it's necessarily something that indicates the performance of the group, but I think it is of some interest, but maybe not taken too seriously. If you look at the revenue per employee, and it's just a simple calculation, take the total group revenue and divide it by the average number of employees in the group for the year. If you look at the Bidvest group, which we all know the Bidvest group, very, very substantial. I don't know how many employees, but there's 100,000. The Bidvest group per employee generates revenue of 1.1 million per year. So employee includes everyone. So it's your reception, it's your cleaning staff, it's everyone throughout the group from top to bottom. So they're generating revenue of 1.1 million rand per person employed by the group. EOH, which is A better comparison for us because they're a competitor to, well, it's unfair. Based on their size, I should probably say we're a competitor to them rather than they are to us. That's probably a bit unfair. But they certainly are in all of the markets that we're in, and the organisation who we are coming across the most in all of the markets that we're operating in. And their revenue per employee, a little bit below Bidvest, but 900,000. Adapt IT, company also growing very, very well, very close to us in terms of share price performance at the moment, although they will fall quite quickly behind as we go forward. They're also doing 900K per person. BCX, also comparable to us in certain sectors, but just out of interest. None of them are directly comparable, but also $1 million, which is interesting. And then MMG, we're also on $1 million. So that was just an indication of activity for employee for what it's worth. I'm not suggesting it's a meaningful benchmark. If I, however, go to headline earnings per employee and see how that works for the same companies. Now, Bidvest, I actually find this quite astounding, given everything you know about Bidvest. So per employee, they're earning 38,000 Rand a year, which means if you just apply the sums very briefly, if they could get each employee to contribute 1,000 Rand a week, which doesn't sound like a lot of money, their headline earnings would go up 30%. And 1,000 Rand a week doesn't sound like a lot for each employee to contribute to the bottom line. So they're not even making 1,000 Rand a week out of their total employees, which I must say I was very surprised by that when I was looking at the numbers. EOH doing better. So on average, their employees generate 61,000 Rand a year for them in after-tax profits. Adapt IT, 84,000, so better. BCX 13, there's just stuff going on in BCX, so that's a very bad comparison given the size of the business. But interestingly, MMG is 111,000. It's something it's worth watching. It's something that I look at in terms of the activity, and I would like to think if we continue to get things right, and if I'm saying that we are getting things right, and we're getting the right margins, and we're getting the right efficiency, we're getting the right growth, and we're keeping our costs under control, then I would expect that to continue. So again, it's more a little bit of fun, but it is an indication that we're getting some things right. LFC. Now, that is not the beginning of a slide showing you we're going to buy Liverpool Football Club. Because every time I mention LFC, people say, we know exactly what you're talking about there. LFC stands for latest forecast. It's something that even within the MICROmega group is very, very familiar with because we talk about it quite a bit, especially at the end of the month. And essentially what we are doing there, and I'm going to be as bold as to say I don't think there is another public company in the world that manages a business by way of latest forecast. I think most people use budgets. We don't use budgets. We think budgets are useful. I think if you're a BMW or a company that's looking at mass market and budget control, I think budgets are useful for them. But if you're going to be growing your business at the rates that we're doing, and I repeat, and we're going to continue to do, you can't do it by setting budgets. If I was to sit down with the executive team 3 or 4 months before the year end and try and come up with a budget for the following year, I'm going to get at best 30-35% growth because no one has visibility in a business growing at the rates we've got as to where it's going to come from. It would just be numbers on a piece of paper, and I would say to the guys, give me 50, give me 60, and they'd give me 50 or 60. There'd be no substance, there'd be no basis. It would, and in fact, it'd be even worse than that. I think if you tried to interrogate a budget and you can't get visibility because you just simply can't get it in a high growth business, you're going to end up with a lower budget. And then once people have achieved the budgets, you get that natural kind of switch off that happens in big businesses. So in order for us to grow at the rate that we are growing, we had to find a different way of doing it. And the way we do it is through this process of latest forecasts. So what happens is every single month, so we don't start the year with a budget. We just start the year by saying, you're in markets that must grow, your job is to grow them, and you have to grow them, and your performance is based on growing them, and we need to know your latest forecast. And during the course of the year, based on the actual performance, management have to come back every single month and give the latest forecast every single month. And that's interrogated every month. What have you done in the last month? Why is your latest forecast the same as it was last month? What have you done the last month? Why haven't you grown your business? And it's very, very demanding. It's very, very intensive in terms of getting systems and performance measurement to support latest forecasting. Budgeting is easy. It just sits there for 12 months and you report against it. So it's very, very demanding. It leads to very interesting review meetings at the end of the month when we interrogate the latest forecast, because again, it's not just giving us a number. If someone gives us a number that says my forecast for November is now this, we say, why is it that in November? What have you done? Have you got an order? Have you nearly got an order? It can't just be a number. So the whole thing is a very, very, I think I'd say, aggressive process of interrogation and making sure it does work. But what it is doing from a management point of view, it means that every single month, every single company has got to come and explain what they've done in that month to grow the business. And we also say to the management team, forget about year ends. Year ends don't matter to you. They matter to us from a reporting point of view. But we don't like this idea of rushing for the year end and trying to meet a target for year end, and then things go quiet for the next couple of months. We're saying every single month you must be growing your business. Forget year ends. That's something we report on. But you from a management team must just keep on going and just keep on growing your business every single month. April's as important as March, even though it's the first month. Yeah, it is true. If you have a bad April, you can catch it up for the rest of the year. But that's only if you think in terms of cycles of reporting periods. We're alert to the fact we have to report. We're alert to the fact that shareholders are getting figures twice a year. But the message of confidence we have is our ability to say every single month we're sitting down with the management team, and every single month we're saying, what have you done? Not for the end of the year, but for next year already. How much of the growth this year have you reinvested back in next year? We need to know that every single month you're doing something to grow your business. And it's taken some time internally to get it properly instituted from a reporting point of view, from a culture point of view. It's been very demanding, I think, on the executive, because the meetings can get quite uncomfortable. It's been very demanding in the accounting staff to make sure the systems and controls are in place to report on this type of basis. But it's an absolute key to success in what we are doing here. If every single person, every single day, every single month is worrying about how do I grow my business, and I know at the end of the month, not once a year in a budget, do I have to explain it. Every single month I've got someone coming and saying, what have you done to grow your business? So it's a very, very interesting management and monitoring tool. It's something that I think it's fair to say that not all management is comfortable with. I think it's not easy to deal with, and certain personalities work with it better than others, but it's something that I guess at the end of the day, if the person can't work with it, then I guess they can go and join another group. And I'm not saying that harshly, but it kind of is the culture. I think if you're going to succeed in MICROmega, I think you're going to succeed in most places once you leave MICROmega. We're very, very fortunate that we have got a great team of people who have already got a couple of years of demonstrated capability in terms of growing our businesses. And I think we have got some very robust financial controls and reporting mechanisms in place to run the group the way we were doing. And then repeat, very importantly, earlier on, to have the infrastructure and resources to make sure that we don't overshoot. Because we want to grow successfully, but we want each level of growth to be a strong plateau for the next level. It mustn't be so fragile that we can actually fall off quite quickly. So it's something that's very, very, very important to us. If you look at the financial services business, as you'll have seen from the earlier slides, the contribution of financial services to revenue was fairly low, at 4%, and at headline earnings was 5%. There is a business where, if you look at existing activities, I think the management team under Joe Forcale and his senior guys, I think, have done very, very well in essentially a broking business, which has, I think, been in the group for about 14, 15 years. As we all know, the broking market is a very, very tough market. It's a market where you are more in the price taking than the price making end of the curve. We've changed that around this year to a certain extent by bringing some key individuals who we think have got a level of skill in the community that they're able to package and structure products. So we've become more of a price maker, but we're still in a price taking end of the business. We've not really paid much attention to the financial services side of the business over the last couple of years, because the obvious opportunities in meeting our growth targets were in the health and safety business and the IT business. But what we have done now, in fact very recently, Greg and I are working on it, is making sure that the financial services businesses going forward will grow to become something far more substantial. And by the second half of this year, I expect us to have some new businesses in the financial services area where the financial services business will start to become more of a meaningful contributor to the MICROmega Group earnings. It is markets that we understand very well. Certainly, if you look at the MICROmega executive, I think our reputation is probably more in financial markets. I think it is something we understand well. There are some very, very specific opportunities in the marketplace right now that we think we can exploit. So certainly looking forward, I would expect to see financial services as being a much more significant contributor to the group earnings going forward. The labour supply business, now that one is interesting in the sense that to some extent it depends on how you look at the business. If you look at the charts I showed earlier, I referred to it making 2 million profit off 264 million rand turnover. But interestingly, if you look at the business different, more like a bureau service, of the 264 million turnover, 239 million of that turnover was running people's wages for them. So we've got clients where we're actually running their wages and providing a service, but part of the service is we pay the wages, then they pay us the money afterwards. So if you strip that out, and you were operating in a different business model, say as if it's a bureau service, and we said to them, we will do all the work for you, we will manage all the admin for you, but we want a fee for doing that. The business would have shown about 25 million turnover and 2 million profit. And that business is capable of doing maybe 5, 6, 7 million profit. But because we're running this high level of turnover, you get this high amount of working capital tied up that really adds no value to the business whatsoever. So you've got almost a $250 million worth of turnover at the MICROmega level. That's a bit confusing because there's no margin on it, and it's really just a question of writing someone's payroll and then they pay us back a week later. So there's a distortion. So if we look at that business going forward from a latest forecast point of view, coming off the base that we've seen over the last year of a 2 million contribution, I think even in a worst case scenario from a growth point of view, it will grow significantly above that. But the other challenge we've got is to change the business model, because what it is doing at the moment is it's tying up too much of our capital. The return on capital is not good. So unless we can change the business model, it's an area that certainly we wouldn't be looking to grow significantly, because what we don't want to be doing is running other people's payrolls. It's capital. If we could get back into the group by cutting back on some of these activities, we can certainly use that capital far more efficiently and far more profitably in other areas. So the challenge, Craig Gordon-Bennett is in there. He's been looking at restructuring the business. So what we're going to do is look at restructuring that business to try and have a different business model so we can still make good money out of it, but more providing a service, but not running the payrolls, and looking at other ways to try and free up some capital. So, from a forecast point of view, I think what I can say beyond doubt is that while the performance historically has been, at best ordinary, there is certainly no downside going forward. I would expect that business to increase profitability in fairly high multiples from the current level. And I think we've also got a kind of fairly stable structure and a new management team in place there. So from where we've come, I think I'm looking for a far more significant contribution from that business, but also a repeat to try and free up the capital that's been tied up for very, very poor returns. So a lot of upside in that sector of the business from the current position. The occupational health and safety business, I'm sure most of you are aware, has been the stalwart, as I said earlier, of the group over a number of years. That business just grows and grows and grows, and I think will continue to do so. It's a business that grows unevenly very often. It's not a business where you can say it's going to grow 50, 50, 50. Some years it might be 30, it could be 70, it could be 60. And part of that is just the nature of the business. There's reasonably long lead times in the products. There's a cycle of research and development where they're developing new products, new training courses, and sometimes it can take time for them to evolve. It's a business that's most prone to, if I can call it, sector difficulties. We've seen very, very difficult times in the mining sector. We've seen very, very difficult times in the resources sector. We're seeing very, very difficult times in the steel industry, for example. And when you get difficult times like that, a lot of the training doesn't happen. A lot of things get postponed. We're in China at the moment, and we're finding with some of the Chinese difficulties that some of the growth we were hoping for there in some of the areas has been delayed because the state-owned enterprises, because of the economic situation, are deferring expenditure. So you do find there are more bumps in that, but that business has been a steady growth projection, but not straight line growth, but always growing. And we would expect NOSA to continue this year and in future years to contribute high levels of growth. But again, a level of unevenness to the growth, but always growth. That business will never go back. It's always going to grow. It's just in terms of the rate of growth. I had a meeting this morning with the executive team, which is one of our normal monthly review meetings, to look at the latest forecasts, where they see this year going, and the new initiatives. And what I can say is some of the initiatives they've got and some of the new ideas they've got continues to make me very, very excited about the future of NOSA within the group and its ability to continue to contribute very, very strong growth, and also a very, very good cash generator for the group. So that's going to continue to perform, I think, very, very well for us. Then information technology. The information technology is largely the Sabata business. 3 million of the profit from information technology came out of Torito Networks. For those of you who may have attended last year, Torito Networks is a business we invested in partnership with a couple of very, very smart ex-Data guys. And that business has grown over a couple of years where we invested in the business. And last year really was the first year where it came into profit. And we generated 3 million from that business. And we expect that to increase very significantly this year. And in fact, on a percentage basis, I would expect the Torito Networks business to be by far the highest percentage growth contribution this year. It levels certainly well above 100% for this year. So we're very excited about that business. It's got a breakthrough. It's doing really, really well for us. And we think this, in fact, is the big year for that business. And there's also, interestingly, a couple of acquisition opportunities we think in the markets in which they operate in that we think can also kick it on even further. So that, from a shareholding point of view, from a growth point of view, is looking to be very exciting. The major part of the business was Sabata. Sabata is the business that's providing the software, the enterprise software and financial management software solutions to local authorities. It also provides our smart water technology also into the same market. It was an enormously good performer last year. We're expecting that to continue. The business, I would say, is certainly number one in South Africa in terms of the smaller local authorities. We've always found there a challenge with that business to try and move up into the metropolitan area where that's a much more of a large-scale market. And certainly in the software side, that's a market that SAP has dominated, where Cape Town spend billions in an SAP system and another 5 billion trying to get consultants to implement it, and then 10 years later start again. So it's great for the consultants, but not necessarily good for Cape Town. Joburg, a similar situation. And as much as we thought our technology is quite smart, quite good, would work there, we're well supported, certainly from a narrative point of view, by State Treasury. I think State Treasury have said publicly, if you look at the software systems available in South Africa, that we would be rated number one in terms of compliance with what the government want to see coming out of the local authorities. But very, very interesting and very, very importantly, we announced a couple of weeks ago that we did get our first metro. We secured the Nelson Mandela Bay Metropolitan, which is our first breakthrough into that market. So it's a far, far, far more substantial contract, and now moving in more into the type of market where the SAP and the big integrators are playing. This market is very important. It applies to all of our businesses, really. It certainly applies to the NOSA business. But when I made the point about being a price maker, not a price taker, this is a business where our core philosophy and part of being a price maker, not a price taker, is you have to own the IP. So even when you look at the levels of growth that we are talking about, these levels of growth are there and the cash is there despite the heavy amount of money we're investing back into our own product, because we have to own the IP. All of our technology, we own the technology. That's what our edge is. So when we go into a metropolitan like Nelson Mandela Bay, or we go into a local authority and we sell them a software solution, we are the one that installs it, we are the one that owns it, and we are the one that supplies the consultancy around it. That is our edge. If you're looking at other products, say like SAP, a product like SAP is a fantastic product. But if you look at SAP's business model, SAP own the software, but they don't own the market. So if any organization in South Africa decides to buy an SAP solution, you buy the software, but the consultant, the integrator is not SAP. You then go out to tender and you get Data and BCX and Accenture. And if you look at the global SAP market, there's over 200,000 consultants globally of like which Accenture is the biggest, all consulting on SAP. And SAP themselves only have 30,000 of these consultants. So in fact, the consultants have ended up owning the clients, not SAP. So again, our business model makes us more a prize maker. Whereas if someone buys SAP and it goes out to tender, then it means BCX and Didata and EOH and Gajima and Accenture and Ernst & Young, they're all competing for the SAP business. So our business model of owning the opportunity from beginning to end, we like to own all aspects of the client, pays off very handsomely for us in terms of client retention, client stickiness, and it also pays off for us in terms of margin as well. So that business, I think, had a phenomenal year last year. Looking at the latest forecast for this year, it's going to have a phenomenal year again this year. And if I look across all of the businesses, in fact, I'm confident enough to say, as we're sitting here today, that we probably already have enough realistic, not quite visibility, but a sense of where we're going, that I don't see it stopping the end of this year. I mean, I'm happy to say already that I think we will have another very good growth year the following year as well. I think we really are very, very well positioned in our markets, and very well positioned, I think, with the quality of the people and the infrastructure within the group to continue at the very high growth rates. From the short term, we have been a top performing share over the last couple of years. I think we were number 3 in the Financial Mail top company list from a share performance point of view. For those of you who don't know, we would have been number 1 in the Business Times top 100 companies list, but we didn't qualify because there's a 5-year tradability requirement, and our share didn't trade enough 5 years ago for probably very obvious reasons. But if in fact with the share tradability, we in fact would have been the number 1 company in the Business Times for the last 5 years. So we will get that spot, but we're just going to have to wait in the tradability side. So I think short term this year, I'm confident enough to say we are going to have another very, very strong year. And I think it will certainly be well above the returns offered by other companies in the JSE this year. And if you look at the medium term, I really can't see any significant risks or any significant events coming in over the course of the balance of the year that would make me think, if I'm standing here again next year, that I won't be giving you the same message. It's obviously too early to say, but certainly there is nothing in the pipeline that would make me feel that the track that we are going to go on is going to be interrupted in any way looking into the following year. Then after summary, I go to finally. So one after summary. But there are a couple of things that we are going to have to address. I think this is the first year, and we discussed this with Duncan and his management team this morning in the NOSA meeting. This is the first year where, even despite our growth, we're starting to see the impact of black economic empowerment. I think our products stood on their own. I think we've been the benchmarks. NOSA is the benchmark in health and safety. And it's kind of carried us through, but I think this year is the first time where we're actually sitting down and saying we really, really have to address the BE issue at the equity level. I think that it is a fact that the equity as a component of BE is going down percentage-wise in terms of the overall computation, but it is something I think we've reached the stage where we do have to look at BEE. We're having some discussions at the moment, whether we do that at the MICROmega level, whether we do it at the company level is something we've got to think through. It certainly will not be done on a discounted basis. If anyone does come in, we'll expect them to pay full price, which we believe the share price at the moment in any event offers a significant opportunity for anyone to come in at the current market price. So it is something we're looking at, and hopefully we'll have more to say on that by next year. It's not something that's causing us any great consternation right now, but we certainly have seen, and Duncan referred this morning to a contract we had where we would have got 7.2 million for this one contract in the health and safety business, and we only got 50% because they gave the other 50% to BE partners. So it's just starting to have an impact on our business, and it's something we are going to address at the shareholder level. Liquidity and tradability. We are alert, and I mentioned when I was standing here a year ago that we are conscious from an investor point of view that people are looking for tradability and liquidity in the share. We did indicate last year that we thought we'd be better off now than we were then, and I think we are. We have brought additional shareholders in. There's more shares in issue there. We've got some vendors out there who have taken shares as well who are happy to make them available in the marketplace. I differentiate liquidity and tradability in the sense that in the strictest of market terms, you can have tradability without liquidity. You can't have liquidity without tradability. But liquidity by our definition would mean that you can trade in reasonably high volumes with low impact cost in pricing. Now, very few of the South African markets, in fact, give liquidity. Very often there's very high tradability. You see it with government bonds, and you see it, in fact, the whole bond market where there's massive amounts of trade. But if you try and move a large parcel, you actually move the price against yourself. So that's not a liquid market, even though it's a highly tradable market. In fact, we've seen it recently with Vodacom. I mean, that was interesting when government sold the stake in Vodacom to the PIC. They gave the PIC a 10% discount on the basis that it was, well, in my terms as opposed to government's terms, they're saying it was illiquid. And that's why they had to give a 10% discount. And of course, a 10% discount across the whole book, if you look at what it would be if you started buying an average, it means you're expecting the impact price to be much more than 10% in the way down. If it was me, I'd have been arguing the other way around. I would have been saying to the PIC, you should pay 10% more for the opportunity to acquire such a book. I don't know why they get a discount instead of a premium, but I guess you have to understand the intent of the transaction. But the point I'm making is, liquidity is one thing and the tradability is another. We can say to institutions, there is tradability in the shares. So if someone was to come along to us and saying, I'd like a package of shares, I'm looking for 1 million shares, we can get 1 million shares without impacting on the market, because we do have vendors who we've placed shares with who are not long-term holders. And if we went to a vendor and said to the vendor, we've got someone who's interested in the share but don't want to buy it in the market because they'll push the share price to 25, 26 rand, which will still look good in a couple of months' time in any event, but let's try and get it at 19 if you can. We would then go to the vendor and say, are you willing to place it? So we do have tradability in the share, and it's certainly a lot better than it was last year, and it'll be a lot better again in 1 year's time. We're very, very conscious of the need from an investment point of view to start using the share and starting to create a level of tradability in the market. So it is something we're very alert to as one of the key things that we think is important from an investor perspective, and it's something we'll keep on working on. And then the final comment I want to make before taking any questions is, on balance, if I look at the share, I think the one thing we can say with absolute confidence is that the share price at the current level, there's very little downside. In a year's time, the share price is not going to be 12, 13 or 14 rand. It's got upside. What the upside is, we can't say. I think it's got a lot of upside still, but it hasn't got downside, and I think we have to be one of the few shares listed in the marketplace right now where, certainly from management point of view, from executive point of view, I can stand up here and say it's almost certain it will go up. It's just a question by how much. But we think there's no downside at all. And I'll take any questions if anyone's got any. At the moment, I mean, it's big in the sense that if you're always looking forward in terms of growth, if we look at the Chinese market, if I just give you a sense of size, well, before I say that, the one important thing about China, and I'm not looking at the health and safety business, I think it's not relevant to the other businesses really. It's really about the health and safety business. The NOSA system was taken into China about 20 years ago. So it's one of these products from South Africa where when we go over to China of meetings, and Greg and I have had many together where we've gone and met governors of the provinces to introduce the product. I think Duncan's obviously had very many as well. And there's a very, very strong recognition of NOSA in China. We have delegations coming down here. We hosted one of the governors of one of the provinces. Now that province is twice the size of South Africa, that one province. And they came down here to get our advice into how we can get get NOSA into the Chinese market. And there's a couple of reasons why China are taking it very seriously. They like NOSA because they know the brand. They like NOSA because NOSA's track record and technology is the best in the world. I mean, when government started NOSA in 1951, and they invested about 1.3 billion rand over the years into the technology, they really, by any standards, NOSA was fantastic. The Chinese standards are based in NOSA, the Australian standards are based in NOSA, the Brazilian standards are based in NOSA. So when you go over there, in a certain sense, it's an open door you're pushing. And China have decided that health and safety is just one of the huge priorities for them, and I think there's two reasons for it. The one is, I think, politically, they've still got that Tiananmen Square mentality where people say China don't care, 30,000 people die in a coal mine incident. They've got another 30,000 people, they don't care. They actually do care. and there's a political imperative to get it right. And the other reason is that as China moves to becoming a dominant player, which is undeniably continuing, as they're partnering international players, the international players are demanding a high standard of the Chinese companies. So we're finding, as we look at that market, if you were to ask me how important it is, I would say certainly in 5 years' time, despite the current difficulties with China in terms of the economy, I would expect in 5 years' time China to be bigger than the whole of South Africa on its own. No, we haven't. Anyone else, or are we done? Okay. Yeah. Yeah. I think from government point of view, you've got a couple of issues which I would even argue are self-evident. I think the one is that if you look at the problems they've got, and I put them in two main categories. The one is service delivery. Service delivery is the most pressing political problem that the government has got. So if you look at our range of products, both in terms of the software and the revenue management side, the one thing we do is give them a far greater capability for service delivery. So we think there's a political imperative to use products like ours, and I think we're certainly experiencing that at ministerial level. There's a recognition of what we can do and the support at the highest level within government, interestingly including the ex-commissioner, even though he knows we're making a few bob out of the process, in terms of actually supporting, I think, what we're doing in that area. So you've got that angle to it. And the other thing is, though, that if you take a lot of our products, they actually pay for themselves. For example, if you look at our water product, I mean, the municipalities are losing so much money, even ignoring the service delivery issue. They're losing so much money that when you put in our smart metering technology and our revenue management, it actually pays for itself. So it's not even a funding issue. It's actually a self-evident, compelling reason for them. And we are certainly getting the sense that they understand both the political need and the economic need to do so. And there's no indication that that's going to change. If anything, I think, as we've really become more entrenched in the marketplace, and as there's more talk about our products working, I think we're going to continue to enjoy far higher growth in that marketplace as we go forward the next couple of years. It's really a very, very exciting market for us, and we get paid. Across all of our services, we're just touching 130 at the moment, so it's virtually 50% of all municipalities that we're touching with one service or another. And enjoying very, very strong relationships with them, where we're finding once we get in, there's an ability to on-sell other products into them. You know, we're actually very, very excited about the opportunities in that marketplace.
What are the views doing that outside of South Africa, and what are the obstacles?
I don't think there's any obstacles. I mean, Dylan will correct me if I'm wrong, but my understanding is that all of the local authorities in Zimbabwe are on our system. We've just secured, Greg's probably got the figures, a major contract in Lusaka on the revenue management side, which is, I think, quite substantial. Okay, so first contract from Lusaka, 14 million. So what we're finding is the products themselves, they're as relevant to the other countries. There's no major delivery problems. You know, the software is easy, it's just software. The revenue management is supplying technology to them. The key for us in all of these markets is going to be make sure we get paid. There are a lot of opportunities to go and provide product, but you're not sure if you're going to get paid for it. So as long as we think we've secured payments. So we really see, I think, Africa, Greg, it's fair to say, as being a strong opportunity off a very, very low base for us to grow the business over the next couple of years.
We're also doing all the Namibian market
Namibia as well.
When you finish with the Sharks, any chance you'll sponsor a decent team like the Lions?
It depends on the growth prospects. If you can get them off the table, then we'll have a look at it. Okay, all right. Well, once again, thanks everyone. Have a drink and enjoy yourself. Thanks very much for coming. I appreciate it.